Today we have a very eminent personality from the mutual fund industry who would be joining us to discuss on the topic investing opportunities in the like mid and small cap in the current market conditions. Okay, so let me introduce you, Mr. Balasubramanian, who is the managing director and the CEO of Aditya Birla Sun Life Mutual Fund. Industry belovedly calls him as Bala Sir or Mr. Bala, different names, but he's a very well-known personality. Today's session is one such a session where I also get this feeling that I should talk less and then listen to more of Bala Sir today. I think for everyone's benefit, let me give a very brief, possible brief, let's say introduction to Bala Sir. So Bala Sir is a stalwart in the mutual fund industry. So he brings him almost 3 decades of experience in mutual fund industry as a portfolio manager of both fixed income and equity. That means he's been a fund manager himself from the debt side as well as equity side. So one of the very interesting accolade is Bala Sir handles, being a MD and CEO of Aditya Birla Sun Life Mutual Fund. He oversees 2.5 lakh crores of AUM in the company, which is a leading asset management company in India with 25 years of rich legacy of wealth creation for its investor. So Bala Sir also handles overseas on global mandates as well through the subsidiary companies of the AMC. Okay, so before joining the ABSL Mutual Fund, so he had worked with GIC Mutual Fund, Can Bank Financial Services, and Pandit & Co, which is a chartered accountant firm between 98 and 99. Okay, 98 and to 94. So to give you some of the very interesting milestones or achievements what Bala Sir has done, he's been awarded as CEO of the Year title by Asia Asset Management in 2018 as well as 2020. So he's been conferred as Aditya Birla Group's Outstanding Leader of the Year in the year 2015 and Leader of the Leaders Award in 2018 by Group's Chairman, Mr. Kumar Mangalam Birla himself. Okay. So see, handling a CEO or being a CEO and an MD of a company itself is a great deal of work, involves good amount of time. But you should also hear about what Bala Sir is doing outside, let's say closely associated with other industry bodies. So he's one of the board of governors of National Institute of Securities Markets, which is a SEBI established entity. So other than that, he's also SEBI's Investor Protection and Education Fund, let's say member of the board there. He's part of AMFI. He's taken multiple roles. He was also been a chairman of AMFI for about 2 years, that is from 2016 to 18. So other than all the things what I just mentioned, Bala Sir has also involved himself in the philanthropic work through various charitable organizations, educational institutions to help his contribution toward the society. So he's done his BSc in mathematics as well as he's an MBA. He's an alumnus of IIM Bangalore. He has Harvard. He's also an alumni of Harvard University through their advanced management program. Okay, so I will just briefly touch upon today's topic. Even I'm eagerly waiting for to listen to him. Let me just touch upon what mid cap and small cap, the journey what has gone through. Let me just set the foundation. Then let's say Bala Sir will take it from here. Okay. See, if you really look at mid and small caps, one very interesting phenomena is right from the last quarter of 2020. Most of the experts have been predicting that 2021 is going to be the year of mid and small caps. Okay, so if you look at the interesting, let's say the structure of mid and small caps per se, in general, established fact is small caps are generally considered to be riskier, to large and mid cap stocks. Okay. And at the same time, small caps, performance comes in cycles. They're called as cyclical investments. So if you really look at between 2018 and 20, performance of mid and small cap stocks have lagged large cap stocks. So that means large caps did very well in 2018, 19 and 20 compared to mid and small caps. Now, not just 2018, 19 and 20, if you look at only last 1 year, that is from pandemic, which what we experienced from February end till today. These three categories have been a very interesting, we have seen a very interesting journey from almost 40% correction in the large market indices to what we are today. I think it's a great journey. There is one very interesting theory which says that when the markets are crashing or in the bearish markets, it is always small caps and mid caps to fall first and the large cap to fall later. And at the recovery phase, it's always large cap which recover first. The same thing is actually explained in the chart here. If you look at the blue segment of the line, it talks about Sensex, how Sensex have moved during pandemic, that is during the lockdown and post lockdown, and how small cap and mid caps have performed. So one is this, and then also how large cap and small cap companies have been affected. Despite of, like let's say fall in sales and despite of all the lockdowns and everything, if you see September and December quarter ends, the profitability, that is profit after tax of the listed companies have gone up. So that's a very interesting phenomenon, right? We assume that profits would have gone down, but in general profits have gone up. But it says profits of listed companies have gone up. But does it mean that all the listed companies, that is large, mid and small, or is it only a few segment of these large, mid and small have done well? That data, if you can slice it down, if we really look at all the listed companies, if you put them in 10 baskets based on their size, okay? So here in this chart, if you see D1, D2, D3 are all large size companies. That's why they are in the first decile, second decile, third decile, whereas 8, 9, 10 are the small size companies that is in their last decile. Now, the chart, what you see is the sales growth or the revenue growth of non-finance listed companies data. Whereas if you see, the sales has not really affected much for large size companies. So that means recovery has been relatively smarter for them. Whereas the, recovery has been tough for smaller companies. That's what at least the data is suggesting, right? So it is not only during the lockdown and post lockdown, even before lockdown, the revenue of the companies have been shrinking for the preceding 3 quarters. So this is where the journey, what we have seen. So now it's for us to understand what's in store for mid and small cap stocks or mid and small cap opportunities. Let's hear it from the man himself. I would like to welcome Bala sir without wasting much time.
Thanks, Karthik, for this nice introduction, as well as set the ball rolling for discussion on the small and mid cap segment of the opportunity that the market at this point of time is still throwing up. I'll just very quickly give you how the market evolved post to COVID. When the COVID was announced, I remember the date, 23rd of March. Definitely, if we just put the entire country under lockdown across the world, naturally the economic activities of various countries get impacted. Therefore, from a positive growth, you go to the negative growth. And no activities means no growth, as simple as that. And no sales means no profit. And whereas the cost remains. Therefore, the market became jittery. The absence of growth, the absence of earnings coming in, the presence of cost continuing, then how the companies will be able to deliver performance. I think that was the fundamental, the reason on which the market fell sharply. We can always say that market is irrational and rational. And this particular one came on the base of this. At the same time, the market also looks at beyond one quarter, 2 quarter kind of things. So therefore, the market starts looking at, okay, this problem will remain for 1 quarter, 2 quarter. After it will come back. Therefore, the first time ever, when the regulators, when I mean regulators, Reserve Bank of India and India, Government of India on the other side, they came together and they made huge decisions of various kinds, including bringing down the interest rates and including giving MSME a guaranteed refinancing through a special window and so on and so forth. Therefore, they took many steps which actually gave confidence, and they kept taking those decisions continuously. They didn't stop it. They announced it, they assessed it, and then they realized it's not sufficient what they have done from the market recovery point of view, economic recovery point of view. Therefore, they need to do more. They need to do more. So that the belief of need to do more to get back the economic growth continuously, the effort which the government of India has put in, continuously taking all the policies that they were rolling it out, and then the Reserve Bank of India kept bringing down the interest rates and also keep improving the liquidity in the system, not for 1 month period, 2 months period, for a 3-year period. So this is the way I think the entire COVID period, the government of India and Reserve Bank of India together, they kept addressing various needs of the market expectations and also the various needs of the economy that will help actually the economic growth to come back. So that's where I think during the COVID period, while the market remained uncertain for a period of 3 to 4 months period, in fact, the pent-up demand started coming in the month of July, and that kept improving. Today, we have reached a level where the 2021 or 2022, we'll probably see the economic recovery come back very sharply. So this is the basic principle on which the markets have moved. During the same period, normally what happens is in the last 2-3 years, in the absence of growth, in the absence of power of the policy reforms, which both Government of India and Reserve Bank of India are doing, are not being felt. Therefore, everybody is playing the safety game of going into the large cap names for a brief period of 2.5 years. There used to be a time where we all used to think that the market is driven by only 5 stocks, and not just only in India, even globally, like quality of the FANG stocks, they used to drive. Second, during the same period, a theme got developed, which is basically saying 5 stocks versus 495 stocks. It's suppose you take S&P 500 as a 500 stocks, only 5 stocks used to perform. So a lot of people used to start tracking how 5 stocks are performing versus 495 stocks. Just imagine only 5 stocks are performing, 495 stocks are performing during the period of uncertain time. When the COVID period, what happened is, while uncertainty used to be there on the economic growth in the past, but definitely the COVID period removed the uncertainty and then brought back the confidence and hope quite substantially. And I'll just tell you in a brief minute why did it happen. One, the issues of the need of money of most of the Indian companies or borrowers are not getting recognized by Government of India, that need to get addressed. And post-COVID period, they addressed it by guaranteeing all such loan by banks by way of giving Government of India guarantee. The moment give a guarantee, then naturally, if I'm a lender, I go back to the borrowers and lend money, knowing very well this borrower may or may not be able to pay back my money, but there is a Government of India guarantee. That's where the confidence came back. So I call it as a credit rotation, where the credit rotation are coming back, which are getting stalled for almost 2-year period. The second is Reserve Bank of India, last many number of years, they have only one goal. The goal is actually keep the interest rate low. When the interest rate is low, that interest rate low should also benefit everyone. It should not benefit only the large name, large companies. It should benefit you and me as the borrower. It should benefit small companies which are in the borrowing market, the mid-sized companies. Normally what happens, a good guy gets the lowest possible rate. The mid-sized companies get a higher rate of interest. Therefore, higher rate of interest they have to borrow, and naturally it becomes unviable for running a business more profitably. So that's why I think Reserve Bank of India, when they cut the interest rates, that long-awaited transmission of interest rates. So today, all of you would notice that home loan rates has dropped to about 6.85, which essentially means you and me as a borrower is able to get a cheaper financing at 6.85%, which is one of the lowest in the last so many number of years, which Reserve Bank of India, Indian banking system has brought, thanks to the Reserve Bank of India policy framework. So they have addressed it. Therefore, the transmission of interest rates also became powerful. So during the COVID period, all such things happened. While you do that, the naturally low interest rate is going to benefit large pool of companies. The companies will get a significant benefit are those companies are in the mid-sized companies, smaller mid-cap kinds of companies. They get two benefit. One, low interest rate, and second is they also get the money on rotation that comes back. So therefore, we saw actually a revival of interest. And finally, when Government of India, I was addressing the budget. Then naturally the budget, most of the time we look at how the budget is going to be managed on tax, how the budget is going to be managed on fiscal, and so on and so forth. The government of India did very smartly this time, beat whatever the concern could be in the market. Let me just take a bet of printing money and increase the fiscal deficit, spend money on the sectors that matters to us for getting the growth back. So basically allocating, I call it the capital allocation, was one of the highest towards infrastructure sectors, towards rural sectors, towards auto sectors. All such things, they of course kept a large pool of money towards the sector in the form of capital investment rather than spending money just freely and then increase the fiscal deficit. So naturally, this budget addressed the various sectors' needs and allocated a large pool of money. Did they allocate for only 1 year? They didn't do. They allocated for a 5-year period. Nowhere in the past, in my own experience, the budget never, they always used to give a glide path as to how it's going to go in the past. But the way they have now done on the expenditure, they have now given about next 3 years roadmap. The moment you give a 3-year roadmap, as we all build business plan, as we all build our budget for next 2-3 years period, so this budget exercise also boosts the confidence of improving the confidence in the market. That's why you saw the market actually moving up on the basis of that. So when all such things happen, naturally, the GDP expectations improves, economic activities come back to better and aggressive path. Consumer behavior, given the fact that interest rates are low, and also given the fact that the consumers in the last 9 months are sitting at home, not spending too much of money, and all the money that was not spent became a savings. So therefore, the pent-up demand could also potentially come, and that's the way I think the whole economic activities picks up. Whenever the economic activities become broad-based, so there is a tendency for a small and mid-cap companies to perform better. Let's see, historically, whenever the overall economic recovery expectations gets better, and that becomes an all-round economic growth that we can expect. And the way, whenever such thing happens, the mid and small cap companies tend to perform better in the market. My own belief is the last 2-3 years and post-pandemic period, the way the government of India has been addressing the needs of getting back on growth by doing the right allocation and right spending to the right sectors, which can provide a greater economic activities come back, as well as the employment to come back. So that's the way they're addressing it. Such addressing definitely, I think, creates a case actually for smaller companies to perform better. And then the small and mid-cap companies generally have seen on such kind of period, they also, of course, get back on growth path. So at the end of the market point of view, as Karthik mentioned about earlier in one of the slides, the earnings as a master. The earnings, when it will come back, there are 2 areas earnings comes back. One, of course, the revenue pool increases because most of the companies have to sell their product. Therefore, the revenue pool has to increase. That's one part. The second part, of course, is the way you manage your cost structure. Definitely, COVID is something has made a lot of people to learn a new cost structure model, and therefore the cost structure is coming down. And third, of course, is the interest cost structure, which is basically the financing cost. The financing cost also now is coming down. So this is where the recurring expenditure of different kind is getting channelized and optimized in order to improve the profitability. The interest cost it's coming down, and therefore they also ultimately will lead to an increase in bottom line, which is nothing but a profit. The higher the profit will start coming in, and that with the economic activities coming back, and expected the revenue growth coming on the top line, then naturally the companies will start doing better. Then second, of course, the point is, unlike the past, where most of the decisions in the country used to be driven by central government budget. Fortunately, the Prime Minister drive of the fiduciary system, changing it more in the interest of the state government to do a lot more activities. They're forcing the state government to allocate more resources for development activities. Today, every state actually is competing among themselves to bring in higher level of contribution to themselves as a state first, then comes to the nation. So therefore, there's a high level of competition that is coming in. So it's also now making every state to be completely aligned to the central government policy, whether it's respect to the building road, whether it's respect to building canals, whether it's creating employment, or whether with respect to the attracting foreign investors to invest in India, the form of manufacturing activities, everywhere there is a competition. There is a healthy competition, there is a right way of thinking, and every state today, post-COVID, I would say they are not making a noise, but every states have come together, one common ideology that we need to get back on growth and do good for the states. So that's something that, as a result of that, the economic activities which otherwise restricted to only few parts of the country, today is of course getting expanded to the most of the states in the country. And therefore, the many companies in the space of small size companies, whether it is in the manufacturing or in the service sectors, they all tend to do better. So that is the way I think the mid and small cap company is becoming one of the largest focus. And then if you analyze actually more deeply, there are various sectors, companies, all in the mid-sized companies. See, if you take actually auto as a sector, and if I have to give an example, and there are many companies who produce cars, commercial vehicles such as trucks, the light commercial vehicles, and then trucks and kind of models that they build. Ultimately, all such kind of companies depend on small size companies to supply parts. Then naturally, if there are activities at the OEM, which is the original equipment manufacturing companies, it increases. Then naturally, a lot of companies whose fortune are dependent on these companies, they tend to perform better. So which basically I call it the auto ancillary companies. There will be many auto ancillary companies which are small in size, but they cater to certain segment need of the manufacturing companies and the original equipment manufacturing companies, and they of course need to also support them. So that's where the order book question increases. The same way when the rural activities picks up, when the rural activities picks up, of course, it largely comes from the form of construction. The moment you say the construction picks up, the naturally demand for steel increases, the demand for cement increases, the demand for aluminum increases, the demand for labor increases, the demand for home furnishing increases, and the demand for the household items, it increases. There are many companies who are in that space, they tend to get benefit. And the same way, if you look at the technology space or service industries, there are many small size boutique companies, small size companies in the technology space also support the larger companies by outsourcing activities. And fourth, of course, the pharma sectors. As you know, that India is actually known for pharmaceutical expertise, as we are known for IT from the global point of view. There are many companies that are small size companies. They're not big compared to the Sensex companies and Nifty companies. They're all mid-sized companies. There are many such companies also tend to benefit as a result of these activities. Therefore, the segment in which the main companies operate, small and mid-cap companies operate, they all operate in multiple sectors, and each of these companies have got various, gone through some of the cycles, but companies have actually gone through ups and downs, the form of their own survival, because when the recession happens, mid-sized companies get impacted. When the growth comes back, they tend to give a much better return to the investors. So that is what I feel. We are in a scenario today that the markets, of course, have been running, no doubt. It touched a new higher about 47 plus, largely driven by flows coming from overseas, driven by hope and optimism of growth coming back. In such kind of flows, when it comes, naturally the flows tend to move towards large cap. But at the same time, as the large cap becomes valuation wise, see today everybody will ask questions about 30,000 index, is the valuation is cheap, is the valuation is costly, all such question comes. Whenever such question comes, then naturally you start looking at the rest of the market and see actually where the value lies. So this is where I feel the mid and small cap companies probably will start getting that attention of the investors like us, mutual funds, investors like overseas investors, and investors, even the promoters themselves, start realizing the value of these companies and then start looking at creating value for the shareholders, either by focusing on increasing the business opportunities or increasing the or focusing on his own balance sheet management. That's where this whole cycle begins. So my own assumption is, having seen reasonably good market for Sensex and Nifty, and having seen a broad market rally that we have seen, I think time looks like has come. For the next 2-3 years, we'll probably see the mid and small cap companies to do better. So how do you define mid and small cap company? The way we define any company is less than roughly about 25,000 crores will come in the mid-cap companies. Any companies with less than 5,000 crores market cap would come in the small cap companies. That's where the definition comes. See, as you go on, of course, deep dive and identify potential opportunities in this space, then naturally, on the basis of the power of growth coming from these kind of companies, would drive the stock price. Just to give you an example, there are many companies in India. My own experience, I used to track Hero Honda as a company in the way back in 1992 as a small size two-wheeler manufacturing company. But the TVS Suzuki, as I'm just taking this example, not as a recommendation, just for increased understanding of how the mid-cap companies become over a period of time large companies. So Hero Honda is when I took an example, the very small size companies, we used to call it as mid-cap opportunities. Today has become one of the largest companies. There are many such companies whose management is in the right product. The management has got a high vision, and the management also has got a deep understanding of the future growth, and they all tend to become bigger. Therefore, such kind of companies, they start as small, and then move as mid-cap companies, then eventually become large size companies. And that's why most of the time, historically, if you look at the last 25 years, in my own experience, there are many such success stories, they become bigger. And why I'm giving this example, the multiplier effect, and the multiplier effect of the return. Then normally, if you look at the chart, there's one other chart, of course, I don't have the chart, but that's why I normally use it. And over a period of, say, 10 years, 15 years, given the fact the small and mid-sized companies can grow at, say, 25% CAGR or 20% CAGR, there is a matured companies, very matured companies, big size companies, beyond a point, matured companies to grow at, say, 28%, is not going to be that possible. I think as you become bigger and bigger, your ability to run faster would get stagnated. You will become a mature player, large player, relevant player, but at the same time, your rate of growth would be only so much. And I mean rate of growth is about, say, 10%, 11%, which is closer to the GDP plus nominal GDP growth. But if you have small size companies, your vision, ability of the management, all of them will actually make them run faster to drive the business and grow at, say, 2 times of your GDP growth. The GDP growth is 11%. There is a high probability the mid-sized companies will build an ability to grow at, say, 2 times of that, say 22%. The moment you say 22% growth at which the companies can perform, and I mean growth is a profit, sorry, it's a sales, and then it's a profit. I think both are, I'm saying 22% rate of growth. The moment you say it becomes 22% rate of growth, such kind of companies in the stock market, higher the growth, higher the stock price, and higher the stock price, higher the return in the long run. That's the way the tendency works. At the same time, when an economic downturn happens, it actually will reverse also happens. If the economic downturn happens, mid-sized companies would also have the lower growth, therefore the lower earnings, therefore the lower price. So this also happens many times in small and mid-cap companies. Therefore, there is a tendency for people to be a bit critical that mid and small cap companies are not given a return, and therefore is it a segment to be in? The risk is also high. I'm not saying the risk is not high. The risk is, of course, is high. At the same time, if we give a longer time period for mid and small cap kind of companies, and given the fact that ability to grow the balance, grow the top line and bottom line, at an average of about, say, 2 times of the GDP growth, which is ranging from 18% to, say, 20%, then the potential return that can come from this segment in the longer term is high. That's one point. This is a fundamental principle on which mid and small cap companies are being driven. Second question is why at this point of time? So what is the reason for one to look at this space today? So clearly, as I mentioned earlier, the markets have been rewarding the large cap companies. At the same time, lot of steps that is being now taken are more in the nature of creating a widespread economic growth in the country. The moment it becomes a broad-based economic growth, driven by low interest rate, driven by high spending coming from the government of India in multiple forms, and also given the fact that the private sector companies will also now start investing. And third or fourth, of course, is the consumer behavior like you and me. Once they start spending as the pandemic gets over, then naturally the growth, I think, would become not just for 1 year, it could become a long lasting. The lastly, of course, the way India is being looked at. See, today, the worldwide money has been going mostly to US for the last 10 years or maybe 12 years. Therefore, US has been one of the single largest good market in the world. And India, of course, has not performed as big as high as US. And it appears to me for the next 10 years, emerging market will probably go the way the 1991-92, the period the emerging market became one of the place to invest from global investors' point of view. It looks like in the year 2021 and beyond for next 10 years, India and other emerging market in Asia seems to be the big focus area for foreigners to invest their money. And within that emerging market, higher allocation towards emerging market, it also appears to me that India will become the one of the largest recipient of that money, and that potentially could come in the private equity space. It could come in the main equity space, and within the equity space, it could also come potentially in the small cap space. So that is the way I see it coming in. So naturally, this would potentially keep the buoyancy, not just for 1 month or 2 months or maybe 1 year. I think it can keep the buoyancy beyond 1 year period. It can get extended to say about a 10-year period. That's where I think the whole base now is getting created. Therefore, 21, the new decade beginning, could potentially be a biggest reward period for mid and small size companies, still in the base of that argument that I'm giving. And of course, at the end of the day, unlike the Sensex or Nifty, where you deal with only 50 companies or 30 companies, the mid and small cap companies, one, come from multiple sectors. The number of companies to track is very, very large. So this is where the money managers like us, of course, have to deep dive in understanding companies on the financial and the fundamentals basis, the business in which they are in, the business, the growth that can come as we move forward, on the base of the what I just mentioned, the multiples of year after year growth coming in, and finally, of course, the governance of each of these companies is what is something that will remain extremely critical in selection of company in the portfolio. Any company with the governance, if it lacks, the company may tend to do very well in the short term, but in the longer term, it may fail to deliver return. And therefore, governance, while picking up companies, would also be extremely critical. That's why money managers like us, when you deep dive in understanding these companies, we do have a higher attention in all these parameters for selection of companies. At the end of the day, when you construct a portfolio for delivering return to the small and mid cap investors, that's something would come from multiple sectors. Ultimately, you can't invest more than 35, 40, or 50 stock companies in the portfolio, and that's something will remain as challenging. Therefore, the more research-oriented approach cannot be driven on the basis of the information, news flow that is flowing in. It has to be largely combined with the fundamentals and the way governance has to be looked at, and the way the growth is coming in. That's the way the money manager look at it. Therefore, that makes me feel a greater opportunity in the small and mid cap space, still on the basis of what I just mentioned. So naturally, the cycle of these things goes through every, of course, 2-3 year period. And given the fact that the government of India has set aside a bigger vision for India, in my own lifetime, is one of the best period that we are seeing for the high level of conviction on India, both on politicals as well as the way we manage the pandemic situation in the country. We now become a leader the way we manage pandemic situation in India. And third, of course, the way we present the budget, and today the way we are quite open to bring in foreign investors in India by inviting them actually to set up the manufacturing and so on and so forth. Your taxation policy today is one of the best, for corporate tax being at only 25%, is one of the least in the world. Somebody set up a company today, they have to pay only 14% tax. On the contrary, individual like us, we pay the highest tax rate. At the same time, there are many companies who are going to create job and add to the exchequer in the form of tax or maybe excise. Such kind of companies are being encouraged to set up a shop in India just at a nominal tax rate of about 14%. Such a policy framework, the drive coming from the government, spending money at the right sectors, the right segment of the market, and also the low interest rate regime, which could potentially stay for a longer period, all put together, my own assumption is India would remain one of the fastest growing economy for the next 10 years on the basis of the policy framework, which I just highlighted earlier. All put together, if we have to see, the small and mid-cap companies seem to be one of the high growth potential market. When it comes to, of course, investors, how one should look at it. So investors at the end of the day, and given the fact that I'm addressing these sessions in the Groww app, Groww platform, the Groww itself means that a lot of youngsters, millennials who are part of this platform, they have a long years to grow. Long years to go. And I mean long years to go, I'm talking about their working life. Somebody at the age of 22 or 24, he has another 25 years to do their job, or 35 years to do their job. Therefore, you have long years to go. The longer year to year you give for your earnings opportunities, then naturally your ability to stay invested in any investment that you make is also longer. Therefore, such investors should definitely have a larger exposure to small and mid-cap companies, keeping in mind the power of compounding. The longer the period, higher the compounding, the longer the period, and the better the outcome that one can get on the investment. Therefore, allocation, though I am a firm believer of an asset allocation model with nothing but some exposure to large cap, some exposure to mid cap, some exposure to small cap. At the same time, these allocations have to be done on the basis of expected return. It will vary from large cap to mid cap to small cap. And then naturally, on the basis of power of compounding, generally is high. I mentioned about small and mid cap companies. And naturally, where the power of compounding is likely to be higher, probably a higher allocation should be given, and vice versa. So on the basis of this principle, if you look at it, then naturally, from investors' point of view, have to take advantage of this situation, looking at longer term, and also look at the opportunity that provides, and then have an allocation to small and mid cap names, keeping in mind the potential of the period of investment and the potential that offers from that segment of the market. So therefore, the small and mid cap space, I'm specifically sticking to that. I'm not going to the market in broad, how the broad market functions. I see a greater opportunity, small and mid cap space, on these parameters which is mentioned about. Therefore, that makes a very strong case for one to have an allocation on such a wonderful opportunity that comes at this point of time, on the base of what the overall economic growth is likely to come back. And the recovery, I think, from the economic point of view, would also be made sustainable on the basis of various policy initiatives that the government of India and other policy authorities have been taking, all in the direction of getting back on growth and make it sustainable for a long period of time to provide the economic growth, they provide greater contribution to the exchequer, also provide greater employment, and also provide greater opportunity for many companies in this small space to benefit out of the whole activities. So that's the primary objective on which I'm saying that the segment will remain bullish. So I'm sure you may have many questions, or you may have, Karthik may have some questions from the viewers. I would be happy to those questions and answer them specifically on this opportunity that I'm talking about. Let me just end here, and I will open it for Karthik to have his questions.
Thank you, Bala sir. We will have a short presentation on the Groww platform itself, and then we will be moving on to taking questions from the audience.
Sure.
Hello, everyone. Good evening. My name is Shikhar Singh. I work at Groww, and I'll be walking you through the product that Groww is and all our offerings. And after my presentation, we will take questions from all of you with regards to investment, personal finance, and of course, if you have questions about Groww, then I will be taking those for you. So I will very quickly share my screen. Right, so as many of you might already know, signing up on Groww is very, very easy. Everything is done by a smartphone or laptop. And if you don't have a KYC, we will get it done for free. The entire process of signing up on Groww is 100% paperless. When you open the app, you end up on a screen like this, which we call the Explore screen, which has 3 tabs. There's stocks, there's mutual funds, and there's golds. So the screen that you are seeing is the Explore screen for mutual funds. And similarly, you have a screen like this for stocks, and similarly for gold. Now, in each of these Explore screens, you have an introduction of sorts to the category. You have the best fund, the most popular funds, the top trending stocks,
And on gold, you have one digital gold option as of now, but we will be adding other options of gold also. This is a fund page. So whenever you click on the name of a mutual fund, you end up on a page like this, where you have practically all the details that you need to know about a mutual fund. So it has everything from returns, expense ratio, fund manager's name, similar funds, their performance, etc. And likewise, this is the stock page where you have all details pertaining to a stock that you would want to know. And likewise, you have the gold page where you have details of the digital gold that you're purchasing. Now, something that we feel that many investors do not realize is that in mutual funds, you can do a one-time or an SIP investment. People think it's mostly SIP or monthly. That is not true. You can do a one-time investment also, and you can do multiple types of investments in the same fund. So if you're already having a mutual fund in which you're investing via an SIP, you can do multiple SIPs. You can have 2-3 SIPs running, or you can have SIPs plus you can also do a one-time investment at the same time. So it's all very, very flexible. This is the dashboard. Dashboard contains your investments details. So whatever investments you would have made, those you will be able to see in your dashboard. This is again split into 3 parts. There's stocks, there's mutual funds, and there's gold. In the mutual fund, the screen that you are seeing is the mutual funds dashboard. If you tap on each mutual fund's name, you will be seeing the option to invest more or withdraw or see more details. So when you tap on see more details, you'll be able to see more details, in the sense it's very similar to a passbook where you can see the amount you have invested, withdrawn, the date, the NAV at which that happened, the average NAV, your folio number, etc. Import and switch. So this is one of the most talked about and most popular features that we have on Groww. Let's say you have a mutual fund investments that you started not on Groww but on some other platform or via someone else, and you would like to move it to Groww so that all your investments are in one place together in one dashboard. So you can actually do that. You simply have to import it. So if you go to your dashboard, scroll right to the bottom, there the option to import is there. And in importing also, it is extremely simple, extremely easy. You just need to share an email ID with which your other mutual funds are linked. And there are a few steps, and within a few steps, you'll be able to track your mutual funds on Groww. And once you have imported them to Groww, let's say they are regular plan mutual funds, wherein you are paying a commission. You can, using the option of switch, you can convert those regular plan mutual funds to direct plan, which is commission free. If you have any doubts that you might want to ask us in detail about, you can please email us at support@groww.in. And we also have a very, very comprehensive help and support section, both on the app as well as website. And using the help and support section, you can raise a ticket to speak to us via a call or via chat or even email. Please follow us on Facebook, Twitter, and LinkedIn, and YouTube. For those of you who are new investors, you will find the YouTube channel a very good resource. We have over 5 lakh subscribers to our channel. We upload 3 to 4 videos every week, and they are aimed at making sure that the investors learn more, especially new investors. With that, I come to the end of my presentation. We will now take questions from our viewers.
Sure. So thanks, Shikhar. Thank you, Bala sir, for covering, I think, a very nice but yet very simple perspective of why someone should look at mid and small caps. But there are a lot of generic questions as well, which audience would like to know for an answer from you. So first, and a very interesting question is, especially for a beginner, how do they select a mutual fund scheme, and also what kind of funds they should ideally have in their portfolio if they're just starting?
Yeah. So interesting. Of course, selection process is always difficult. It's like going to a saree shop and try to select a saree. So we'll always find it difficult to select them. And the mutual fund, given the fact that we have a lot of products to choose, it's always difficult. Therefore, I would assume first zero down on 1 or 2 mutual funds. So that's one way to go about it. Just select, say, like there are people who have good number of years they have spent in cycles, and choose 1 or 2 of them. Then within that, when you begin to make investment, first you begin whichever schemes. I think lesser the age, and choose one of the equity schemes, either large cap or multi cap, small and mid cap. You choose some of the schemes and clearly come with the assumption that I'm making the investment for long term. So most of the time, investments always deliver better return. Only if you have the ability to forget about the investment and not looking at day-to-day NAV movements, and then how you are performing in the day-to-day value of the investment that you make. The moment you come with that objective, clearly whatever you have chosen, the longer period, it does deliver it. So that's something which is a beginning. Once you begin, then I normally suggest whichever you begin is fine. But we need to also look at, have you gone to the right asset class? Have you gone overboard on buying, say, equity? Or you have less in equity and more in conservative funds and so on and so forth. The moment you define what is your objective is to, and then you start looking at your reallocation. Okay, if you try to do everything in the beginning, there's a high probability that you will start thinking, you will keep thinking, never begin. Therefore, I always tell all investors, first to begin, make the investment in the equity space with a clear assumption of coming for long term. Maybe small, make beginning with a small amount like SIPs, monthly amount. You can make a small amount on lump sum also. Once you start doing it, then naturally you start increasing allocation towards mutual fund asset class. And I am specifically saying keep increasing mutual fund asset class. I myself have been an investor right from the day I got into a job way back in 1989. And since 92, I've been investing in SAP as an asset class. And believe me, I've never looked at how much money has gone there. At the same time, it has given me a greater experience on such investments, even today, because the power of compounding for such a long period is very, very high. So that is why I would advise all the investors to make a beginning, then keep doing a course correction as you think is right, as per the advice that is coming in, either from your platform or any other platform which you deal with, or maybe advisors and so on and so forth.
Sure. Thank you, sir. I think next question is probably the extension of the previous question. If suppose someone wants to were to create an emergency fund, I'm sure due to COVID, all of us understand the importance of emergency fund. Which kind of funds would you recommend that they should be investing in?
See, emergency fund itself tells you that you need the money at your call. Whenever you want this money, immediately or overnight, right? So that is the way it's looked at. So therefore, and also you don't want your principal at the time of redemptions, or maybe when you redeem your money, you don't want to see a mark-to-market loss. Even don't have mark-to-market gain is fine, but you don't want mark-to-market loss. Your principal has to remain more or less same, if not better. So such kind of opportunities comes only in the liquid fund, called the money market fund or liquid fund, and that's where that comes. Therefore, any investors who normally they keep the money in the savings account, and that kind of investments can come into the money market funds or maybe the liquid funds, which gives you money on an overnight basis, and you can redeem this such investment. They're all T+1, I call it. You put a trade today for redemption, next day morning you get it. Therefore, that's the way the money gets credited in your account. So that's something emergency fund. And actually, it came as part of the various discussion, especially during COVID period. So most of the people during the COVID period, the market crashed. They didn't touch the asset class they invested in equity. They left it as it is because there was a value erosion. Of course, all come back nicely, no doubt. At the same time, which segment of your asset class you touch that point of time for your monthly needs or various expenditure is your money that you have parked actually in the liquid fund. So that's something which I think can be made as a principle while making investment. That's why I mentioned even if you start in a liquid fund, keep putting all your money in liquid fund and then move into equity depending upon your need, aspiration, and expectations. And that's also another best way to do it. You put all your money in liquid fund, doesn't matter, and then keep moving into your other asset classes. That's another way to build your emergency fund as well build your portfolio for the future.
Sure. So thank you, sir. I think in one of the talks, what you had given, I had the privilege to attend. You had given a very interesting perspective towards debt funds. You had mentioned that especially debt funds with a really shorter horizon, the investor's investment horizon should be in line with portfolio's average maturity. That's something what you had mentioned it very beautifully. Probably extend to that question. One of the viewer is asking that should there be an SIP in debt funds? Do you see some? Is it like something a viable concept to adopt? Very much similar to equity funds.
Yeah, see, SIP generally the perceived notion is SIP is meant only for equity. It need not necessarily. Somebody do not have the ability to go through the market volatility, which normally happens in the case of equity. Such kind of investors, I call it as considered investors. He does not have much aspiration to make big money. At the same time, he is okay to get a nominal return, like 6-7% kind of return over a period of time, and which asset class will give you that kind of expectation to be met is the fixed income schemes. So everyone will have large fixed income. Big money they may not have. Even if somebody goes and put money in bank deposits, the middle class investors on an average, they put from 2 lakh rupees, 5 lakh rupees. Even if somebody puts from a SIP point of view, and best case scenario, I would assume the normal investors would put 5,000 rupees or 10,000 rupees or 14,000 rupees. Such kind of investments can definitely be made to invest in the debt fund as well. But I think again, as you rightly put it, the debt fund has got a multiple categories, which is basically put it very simply, the duration, the period. If you invest in a longer period, maturity of the portfolio, it gives a higher return. Also can give a lower return when interest rates goes ups and downs. But the same thing if I choose actually 1.5 to 2 years kind of duration, which is nothing but I invest only 1.5 to 2 years kind of outstanding maturity papers. The natural assumption is after 1.5 years, the money will come back, again reinvest, again money will come back, again reinvest. So that is when the investment cycle happens. Therefore, I am able to capture low in the equity debt market, the interest rate market, high in the interest rate market. So such capturing of movement takes care of the return expectation of investors. Therefore, from investors' point of view, recurring investment, systematic investment can be equally made in fixed income. But just remember the purpose for which you are coming here to protect your capital, get some regular income, that's your purpose. Whereas put money in equity, your purpose is not to get a regular income. The purpose is not to get stable return. The purpose is to create wealth. This is a longer term wealth. Therefore, this purpose, you have to remember the purpose. Your purpose is to get a nominal return, money safety has to be there, and that's the purpose. And choose fixed income schemes, debt funds. Your purpose is to create wealth for the future, for education, buying a house, and buying a car, and so on and so forth. Many aspirations that every individual have got. Your purpose is actually to create wealth for the future, then go for equity. I think that's the way if you're able to differentiate, then you get your SIPs allocations right.
Thank you, sir. So in line with today's topic, if you were to see, what are some of the parameters we could keep for selecting some of the small cap stocks?
See, small cap is pretty tough. Selection criteria, to define selection criteria for any small cap companies is tough. If I have to say, go for a single stock investment. Because it's like the ocean, right? Whichever direction which you go, you'll still not reach your destination because you are in a ocean. Small and mid cap companies like that. Therefore, if one has to define the selection criteria, of course, easy for me to put in a money manager's point of view. From mutual fund point of view, relatively is relatively easy. Yeah, we have predefined parameters to select companies and predefined methodology, principles on the basis of which you manage your money in small and mid cap. In my own case, I can say Our small and mid cap fund is being managed by not only one person, is being managed by all analysts. Every analyst is responsible for a single sector. Every analyst on the sector in which they are responsible, they have to give me 5 top ideas. And those 5 top ideas will come part of the portfolio. So that means the analyst has to identify top ideas, invest, validate these ideas. If you think some ideas are very good, continue. If you think some ideas are not good, find a replacement and cycle in which you want. So that's the way this portfolio is constructed. Assuming scenario, you have to look at the same thing on the small cap point of view. Then you have to go with some parameters of the company's existence for longer term. How long the company has been in existence, which business in which they are in, whether this business is actually for fly-by-night kind of operator business, or the business is going to actually be there for a longer term sustainability model. And then the companies again can be divided in 2 parts, new age business versus the old business. New age business means no profit, but a high growth. Like for example, Amazon was small companies. They were only building top line customer base, all at a losses. Today is making money, right? There are many such companies also could come. Therefore, one has to assess on the basis of individual intelligence and also available information in the market to categorize such kind of companies and then make such investment. But always remember, and such kind of things, you don't make mistakes on companies who may have governance issues. Today, even if somebody does a Google search, you will get what are the governance issues the company may have, or would have gone through, and so on and so forth. Therefore, such kind of companies are difficult to, of course, spot it, but definitely as we are able to avoid mistakes, then naturally the outcome would be better. The last, of course, is avoidable in the mid-cap companies are those who are cyclical companies. They basically will go through a lot of volatility. Sometimes they will get it right, sometimes they'll get it wrong. Then the sustainability of companies will become a question mark. Such kind of companies, how to avoid is only through the experience and looking at the past behavior of companies.
Well, thank you, sir. I mean, I understand. Selecting a mid and small cap is really a challenge. Especially at an investor level, because we have only the past data. By looking at past data, the moment we start taking those decisions, we might end up making those mistakes. So I think to that extent, it definitely makes sense to be part of
Mutual fund.
Mutual fund schemes here.
Yeah, a collection of portfolio.
Collection of portfolios. So, but then there's always that now, if you see in the last couple of years, the passive funds have been really gaining that relevance. Or at least there is broader acceptance in Indian markets, which was not there in the past. So how should we construct the portfolio there? I mean, active versus passive funds. How do I construct the portfolio according to you, sir?
Yeah. See, the way I define active and passive, both will remain active. When I mean both will remain active, there will be a set of market will pursue passive funds actively. And the active money managers will manage the money actively to beat the benchmark. I think both will remain coexist. And they are complement each other. And as I mentioned earlier in my presentation, small and mid-cap companies will tend to perform better as we move forward. So that is why I think your alpha comes. If a Sensex give me return of 10%, say last 10 years, there is a tendency of small and mid-cap companies to give 5-6% higher than that of the Sensex in the longer period. The short term may underperform, I'm not saying no. But the long run, they tend to outperform the Sensex Nifty companies. So this is called alpha, the alpha to the Nifty. Money managers most of the time would make an attempt to outperform the index. Just because they are not performed the last 2 years up to the index, don't blame them. Because you need to give them a longer time period. Therefore, the alpha generation, which is generating return over and above the Sensex, is one of the endeavor of all the money managers. Therefore, active funds will always remain. It can give you surprise on positive side. That the question is, should we avoid and go fully to the index funds, or should you have a mix? My belief is you have to have a mix of both. This part of the asset allocation. You need to have some index funds. I'm not saying no ETF fund. At the same time, you should also have actively managed funds. The actively managed funds will tend to give you over a longer period of time the alpha that you need. whereas ETF as sensitive funds will tend to be with the market. Therefore, at times it can give you a mediocre return, but doesn't matter. I think both combination will give you a better experience. So my belief is it's complement to each other. Therefore, don't ignore one versus the other. Have both.
So in that way, can we say that, will it be too wrong to say mid and small cap makes sense to be part of active funds, but especially after recategorization, I think being part of ETFs in the large cap space would make more sense. You think can we
Yes.
imply?
Yeah, I think that's the way I think one can imply it. Small and mid cap, I think more than ETF model, the being in the active managers would be a better options, because the constant review of portfolios, looking for opportunities in the specific segment that keeps coming up for investment opportunities. That's something which gets picked up in the small and mid cap space. Of course, if somebody has got a large cap exposure, and he has a choice, of course, between choose between the index and large cap. Also keep in mind, most of the large cap funds are also designed to perform better than the Nifty or Sensex. So the design is like that. And the design is actually outperformed by 1 or 2% to the market. And believe me, in the long run, 1 or 2% extra return that you can generate, the power of compounding high. Therefore, you also cannot ignore it. Therefore, the choosing ETF and large cap, it not necessarily has to come fully at the cost of checking the large cap fund fully. Then you can still choose a mix of both.
Fantastic. So make a lot of sense. I think that clarity is, I think, was needed. The challenge here is you have addressed most of the questions what have been asked in your segment of the session itself. But still, even at the cost of repetition, it's good to reiterate sometimes. Markets have done exceptionally well, especially before the economic recovery. We have seen market recovery from 2020 later half itself. How sustainable you think the government or the central bank's liquidity plans are? Because this is what is driving the markets, at least what one could say. Do you think low interest rates and quantitative easing kind of policies would remain?
See, the market, interestingly, I used to run on slide, which of course still I feel is relevant. See, the market is always driven by hope. Then the period of growth, then the period of optimism. So that's why the market goes in cycles. And there is also a period of uncertainty, which is called despair period. So each of the period, if you look at, the market lives on hope. Even today also, the market lives on hope that growth will come back. So I think we're probably going from growth to the growth phase. So what is the difference between each of the phases? The hope phase, there's no earnings of the company comes, real return comes. Market runs faster than earnings. Then the earnings comes back. Because the policy framework is actually start playing its role, then the money starts coming in. That's why the money companies are able to generate profit during the growth period, but the real return is actually low. And then when subsequent optimism period, when it comes, the real return comes better, then earnings of the company also comes better. So this is a cycle in which market always goes through. Any period you take, because historically market goes through these cycles. So I would assume that what you have seen in the market, the hope period remains very, very long, and we are getting the growth phase. There is high probability in the growth phase. The market may not do well as good as the hope phase, but the companies may start doing well. We'll go to the consolidation phase. The companies start doing well, companies' confidence will be high. You and me as an employee of the company, my confidence will be high, unlike the past. And that's something which I think bring back my optimism for the future. Then we go in that cycle. So I would assume while the market has run up quite a lot, but there is this phase of hope to growth and growth to optimism will keep driving the market expectations. Therefore, one has to stay patient on that.
Sure. Thank you, sir. Another very interesting question and a dilemma in most of the investors is, I keep looking at these kind of questions in different forums where people keep asking this. Equity have already seen a good run up. Should I start selling right now?
Which one?
And
Equity,
at the same time, there are also many people who want equities.
Mm-hmm.
Equities, we've seen a good run up in equities. That's, I mean, what the journey from 28,000 levels to 50,000 levels. I think it's a great rally in equities. Is it the time to start withdrawing money? That is one question. Or Or from a rebalancing strategy, you think should someone keep like at least withdraw money from equity now? What's your take?
See, interesting, Karthik. During the pandemic period, immediately after the pandemic period, when the market was at 8,000 and odd, so I used to be having a similar kind of webinar sessions, and I used to actively participate at that point of time. So one of the common thing that point of time we used to say, at 8,000 index, one has to make investment, the market could bounce back. Therefore, give time for the market, policymakers will start reacting. So when the market started bouncing back, I think came to about 11,000 index level. A lot of people used to call me saying, Bala, market has gone up as you had predicted. Why should I book profit? So what do you tell him? So when the index is 7,500, from there, market has bounced back almost 35%. Then naturally, your tendency to book profit will also be high. So you tell him no for once, you tell him no for twice, you tell him no for thrice. And fourth time, it's very difficult for you to say no for redeeming because he's made his money. Right? Just imagine somebody has redeemed at the level of 11th index. Today, the index is close to about wherever the number is today. And that's something that again, further 30% return has come. The market always tends to behave like that. I'm not saying from here 30% return will come. We could probably see some consolidation and correction in the market. But my always belief is you should make your investments redeem only if there's a real need for money for you. Believe me, instead of sitting in the mutual fund, the money comes back to your account. The probability of spending the money either to chase return better than what you earn or spend the money somewhere else. Therefore, the probability of losing the money is far higher. And then having a mark-to-market loss in mutual fund, the market comes down, and then gain the same mark-to-market gain in the future is also probably very, very high. Therefore, my own as a single message I give to all investors, you redeem only if you want this money. Even if the return comes down, this doesn't matter. Redeem the investment only if you want it. Otherwise, don't do it. Like Warren Buffett says, you spend only after complete your savings. Right? That's what Warren Buffett says. A man who is worth billions of dollars, who doesn't need any more money, he still talk about savings. The reason he is saying that you should, the moment you spend and then you try to save, you'll be left with no money. Then the question of saving doesn't arise. Therefore, first you save and then you start focusing on your spending. So that's something as a principle, if you keep even for the mutual fund redemption, you'll end up taking a call. Okay, let me not redeem, let me stay invested for long term.
So then would you at least recommend rebalancing? Suppose if I've kept a target of 70% in equity, 30% in debt, and now the portfolio is looking like 80-20, then will it be advisable now to move that 10% or say for that 5% to debt and then rebalance the portfolio?
Yes. See, rebalancing has to be constant. See, how the rebalancing has to be constantly done. I take only one principle, which is my own formula, which is in today's scenario, if my interest rate, I'm going to get say 5% return, say in a fixed income investment, and then I'm going to get 10% return in equity investment, and then I'm going to get say 10% return in real estate, and then let us assume I'm going to get 5% return in gold. I have 4 asset class I'm taking. So all the asset class, 2 is giving 5%, the 2 is giving 10%. Then naturally, I need to look at asset allocation model. Do you want to put all your money in 10%? Absolutely no. Would you like to put all your money in 5%? Also no. But can you put some in 5, some in 5, some in 10, some in 10? It's real estate, some in equity, some in fixed income, some in gold. The moment you fix this formula, basically the higher the return, higher the allocation, lower the return, lower the allocations. So if you keep doing this on a periodical interval, then naturally your asset allocation model will become perfect. And since you are doing this every year repeatedly, and the probability of getting a success on such a rebalancing would take care of your risk associated with all the investment that you have in your portfolio.
So I'm sure this is exactly what your dynamic asset allocation or balance advantage fund would do. I mean,
yes, exactly. So therefore, you are in the absence of you not able to take the decision as an investor, you leave it to the money managers like us who manage the balance advantage fund exactly the same way. And you asked a question about market.
Yeah.
Today, the balance advantage fund formula says the market has run up quite a lot. Therefore, from here it will not run further as much as what we think. Therefore, the equity allocation today is about 45% in the portfolio. The same fund manager, exactly about 8 months back, he used to have 85% exposure to equity. At that point of time, he was so bullish on equity, he took his equity exposure to 85%. The advantage of such kind of funds, the money manager, when he does actively moving from equity to debt and debt to equity, and then keep the asset allocations continuously, I think it makes the job of you easier. You give the responsibility to money managers. Such kind of funds will tend to give you a stable, predictable return in the long run.
So then it makes sense, even the rebalancing job to be given to an expert rather than us doing it ourselves, right?
Exactly.
One last question, sir. Suppose if you were to construct a portfolio of equity funds, say for a first-time investor or an existing investor, what are some of the schemes you recommend should be there? Like some all-season funds, according to you.
Which are the funds you are saying?
Which category of funds should be there? Category of equity fund should be there, whether it's a first-time investor or an existing investor. They should have it all times.
Yeah. See, if you take the equity schemes, you have a large cap, you have a large and mid cap, then you have a multi cap, then you have a focused equity fund, then you have a mid cap and small cap and mid cap kind of fund. Then you also have thematic fund. Thematic funds will take into account digital fund, pharmaceutical fund, banking and financial services fund, and so on and so forth. So in this, from unlike the past, there is a lot of confusion on selection of schemes. Today, there is absolutely no confusion. Each of the categories are well defined. The scheme itself will tell you whether it's a large cap or mid cap. You don't need to go and ask anybody which fund it is. There is a very well prescribed definition that I have given as a mutual fund industry. Therefore, from an investment point of view, and if you don't want to take either side, the large cap or mid cap, the multi cap fund as a category will take care of your investment needs for both in mid cap companies and large cap companies, a mix of both. Therefore, from an investment point of view, the mix of these two could also be one of the options to choose at all point of time. And second is somebody is fully exposed to all these funds like large cap, mid cap, and the multi cap kind of fund. So naturally, you can go for thematic fund. And I mean thematic fund. The thematic funds like just digital companies, they tend to perform. They're all high growth companies. They tend to perform in the long run quite well. So can I have allocation there? Can I have allocation to banking and financial risk fund? Can I have allocation only consumption driven fund? All such decisions can be taken on the basis of how much you are exposed to equity as an asset class. If you are not exposed to equity as an asset class, you are building your portfolio, the best way to onboard is actually through the flexi cap fund or multi cap fund.
Sure. So thank you very much, sir. One question and a very important question to Shikhar. Shikhar, I mean, in the previous webinar, like let's say events, we have discussed that Groww is testing FNOs at the backend level. The necessary approvals are in place. When can we expect as a product to go on live, Shikhar?
As I have said in the past, it's very hard to give a timeline. I mean, unless you're 1 week away from it, we will not be able to tell you that it's coming. These things, there are so many regulations, there are so many ifs and buts involved. All I can tell you is whenever it's coming, maybe a week before it's coming, I can tell you. But so far, we've been testing and there's a lot of minor things that we need to do and we're doing that. And it is definitely the next big thing in our pipeline. So if that, I mean, that's all I can say at this moment.
So can we just keep ourselves active in Ab India Karega Invest platform? Would you announce it here?
Yeah. So whenever we are very close to it, I would happily come and announce it here.
Okay. So looking forward for the announcement, Shikhar. Good luck with that. So thank you very much, Bala sir. You've really enlightened us today, given us a very interesting and fresh perspective but in your own simple words. I think that's very important. Trying to understand and comprehend is also very important. We've really learned a lot, and thanks for your time. Thanks for spending time with us, and thanks all of you for attending this event. So have a great weekend. Thank you.
Yeah, thanks, Karthik, and thanks, Shikhar.
Thank you, everyone.